Welcome to the deep dive. We're jumping straight into Lumentum's Q1 fiscal 26 results today.
Yep, straight to it.
Our mission,
Yeah.
hit those huge growth numbers, the guidance, and really see how they're set up for this AI in data center boom.
It's a critical look. Q1 was strong, high end of guidance, setting an ambitious tone.
Okay, let's unpack this.
Yeah.
Operationally speaking, Q1 looks solid, high end of guidance, like you said. Give us those key non-GAAP numbers first.
Absolutely. Operationally, yes, stellar is the word. Net revenue hit $533.8 million.
Okay.
Non-GAAP gross margin came in strong at 39.4%.
Mm,
And the bottom line, non-GAAP diluted EPS was $1.10.
$1.10. And that revenue, 58% year-over-year growth. That's pretty staggering.
It really is. Shows they're definitely catching that AI wave.
But the margins, that's what jumps out to me. Expanding margins during that kind of growth spurt, that's tough.
That's exactly the key point, I think. It
Yeah.
points to serious operational leverage, revenue growing faster than costs. The non-GAAP operating margin hit 18.7%.
And compared to last year,
Yeah.
that comparison is stark.
Oh, absolutely. Last year, Q1 fiscal 25, it was only 3.0%.
Wow.
So yeah, that's over 1,500 basis points expansion of 1,570 BPs, actually.
Okay, so nearly 60% revenue growth and margins exploding like that. Is it pricing power because their components are just essential right now, or is it mostly scale, like filling up their factories?
The commentary suggests it's, a mix, but scale is definitely the big driver. When you're making these specialized optical components, that manufacturing is complex, expensive.
Right.
So when you get that kind of volume increase, you spread those fixed costs out. The AI build-out isn't just driving sales, it's making their whole manufacturing operation way more efficient. That drops straight to the bottom line.
Incredible leverage. Okay, so now the really interesting part, the Q2 outlook. They're not tapping the brakes, they're hitting the accelerator, right? What's the guidance?
Yeah, no slowdown signaled here. The Q2 non-GAAP ranges are pretty aggressive. They're targeting net revenue between $630 million and $670 million.
Big jump.
Huge jump. And they expect more margin expansion, guiding for non-GAAP operating margin between 20.0% and 22.0%.
And EPS.
Expected non-GAAP diluted EPS between $1.30 and $1.50.
So quick math. The midpoint there is what, over 20% sequential revenue growth quarter on quarter. That's ambitious.
It's very ambitious.
Is that confidence just based on current orders flowing in for AI and cloud stuff? Or are there risks?
The confidence seems pretty rooted in immediate market demand.
Yeah.
The CEO talked about strong ongoing momentum, intra-data center, DCI, long haul. It's across the board.
Okay.
And what's really interesting is they expect this massive sequential growth before the next-gen stuff really starts contributing meaningfully.
Okay, let's pause there. Next-gen stuff. You mean OCS and CPO, right?
Yeah.
Optical circuit switches and co-packaged optics. Remind us quickly, what do those actually do differently? Why are they the future?
Right. Vital context. If this growth is great, OCS and CPO are seen as the next leap. So co-packaged optics, CPO, it basically changes how chips talk to the network inside an AI cluster. Instead of electrical signals going off-chip to a separate optical box, which eats power and adds delay, CPO puts the optics right on the package with the main networking chip.
So much shorter distance, less power, less latency. Critical for massive AI training.
Exactly. It tackles those huge power and density problems head on.
Got it. And OCS, optical circuit switches.
OCS is more about network agility and efficiency across the wired data center. These switches manage light signals directly without converting back to electricity just to switch paths.
Removing bottlenecks, saving energy.
Precisely. They mentioned some initial OCS ramp already impacting the system's revenue slightly, but the big wave is still coming. So management's basically saying, look, our current stuff is driving 20% plus sequential growth. Wait till OCS and CPO really hit scale.
And you mentioned cloud transceivers, too, the third driver. They're saying that's now on a sustainable upward path. Sounds like they see this AI demand as structural, not just a blip.
That's the language they used, yeah. It signals they believe this isn't just a cycle, but a fundamental shift in infrastructure needs. They feel their whole portfolio positions them well for this AI compute expansion, hence the confidence in Q2.
Okay, let's peek inside that revenue mix.
Yeah.
Where's the AI and cloud demand actually showing up? They split it between components and systems now.
Yeah.
How did each do in Q1?
Both saw huge year-over-year growth, but components really drove the story, especially that margin leverage we talked about. Components revenue was $379.2 million.
Okay, the bigger slice.
Yeah, 71% of total revenue. And that was up almost 64%, 63.9% year over year. Just broad-based growth, inside the data center, connecting data centers, long haul, All of it.
And systems.
Systems brought in $154.6 million, the other 29%, still up massively year over year, 46.5%, led by those cloud transceivers we mentioned.
Right.
It did dip slightly, 3.6% compared to the prior quarter, Q4, but they said that was mainly a planned dip in industrial lasers, and it was mostly offset by that initial OCS ramp starting.
Okay, makes sense. We keep hearing AI build-out. Can you connect the dots for us? What are these specific component records, like 100G and 200G EML laser shipments? What does that mean physically in the data center?
Good question. So EMLs, electro-absorption modulated lasers, think of them as the tiny engines inside the transceivers.
Okay.
They create the high-speed light pulses carrying data within the data center racks. Setting records in 100 gigabit and 200 gigabit EMLs just confirms, well, that the physical build-out of racks and servers needing high-speed links is happening at massive scale right now. Lumentum supplying those core parts.
So that's the intra-data center piece. Any other component wins that really show this is a sustained trend?
Yeah, the one that really points to sustained structural growth is their narrow line width lasers.
Okay, what are those for?
These are specialized lasers for DCI data center interconnect. That's the tech linking separate massive data centers together, sometimes hundreds of miles apart, making them act like one giant brain. These lasers send data much further over fiber.
And how did that specific product line do?
Grew over 70% year over year, and here's the kicker. It was the 7th straight quarter of sequential growth for that specific DCI laser line.
7 quarters in a row? Okay, that's not a blip. That's building the connective tissue between AI superclusters globally.
Exactly. It strongly suggests structural expansion. Plus, they hit a record in pump lasers, too. Those are needed for boosting signals over very long distances, like subsea cables, underpinning the whole global network upgrade.
So current products firing on all cylinders. Connecting back to OCS and CPO, those future engines, what's the timeline look like for them hitting real commercial scale?
They confirmed OCS manufacturing is on track for the planned ramp in calendar year 2026.
Okay, next year.
And the broader CPO ramp, that's expected to hit meaningful commercial scale in the second half of calendar year 2026. So, yeah, the current momentum is strong, but it's also setting them up for what could be another huge wave when the market adopts these next-gen architectures.
Right. So when we see these really impressive non-GAAP numbers, like that
Right.
$1.10 EPS, it's important for you, listening, to get the context. What's the main difference between that $1.10 non-GAAP figure and the official GAAP EPS, which is only 0.05 cents? That's a massive gap.
It is, and it highlights a key thing about earnings. Think of GAAP, generally accepted accounting principles, as the official legal accounting picture. Includes everything. Non-GAAP is more management's view of the core ongoing operational performance, stripping out certain items they see as, well, noise.
And what kind of noise are we talking about here? What makes up that huge difference?
The biggest things usually are non-cash items. Stock-based compensation is a big one, real expense, but doesn't cost cash this quarter.
Okay.
And critically for Lumentum, it's the amortization of acquired intangibles.
Right. Break that down simply. Amortization.
Sure. When Lumentum bought other companies years ago, they assigned a value on the books to things like patents, customer relationships, brand names, intangible assets.
Got it.
Accounting rules require them to gradually write down the value of those intangible assets over time. That write-down is an expense that hits their GAAP earnings every quarter, even though it's not a cash outlay now.
So it can make the company look less profitable on paper than its current operations actually are?
Exactly. Management argues that non-GAAP gives a clearer view of how much profit the business is generating today from selling its products. Both numbers matter, but that $1.10 suggests the core operational engine is quite healthy and generating good cash profit.
Speaking of cash, did they build up their cash reserves during this growth spurt? What's the balance sheet look like?
Yeah, significantly stronger. The cash flow from operations was clearly healthy. They ended the quarter with over $1.1 billion and $121.8 million to be precise in cash equivalents, and short-term investments.
Oh, wow.
That's up almost $245 million from the previous quarter. Gives them a lot of flexibility.
Okay, so strong results, aggressive guidance, building cash. But like we said, guidance is forward-looking. What are the key risks you should keep an eye on? What could derail this optimistic picture?
Right, critical thinking time. The optimism is high, but Lumentum themselves point out risks. Execution is one. If those OCS or CPO ramps slip, if they hit manufacturing snags.
Then the 2026 boost gets delayed.
Exactly. Then there's just general market uncertainty. Global economic volatility could always impact customer spending plans, even for AI.
What about internal stuff, like product mix.
That's a huge one for a company like this. They sell a wide range of components, right? Some have much higher margins than others.
Hmm.
If customer demand suddenly shifts more towards their lower margin, maybe higher volume commodity parts than they expect.
Then the overall profitability, that 22% operating margin target, could be pressured, even if they hit the revenue number.
Precisely. And integrating past acquisitions or any future ones always carries execution risk, too.
So basically, success depends not just on the AI market staying hot, but also on Lumentum nailing the execution on these really complex next-gen technology transitions. Hashtag tag outro.
That sums it up well. The opportunity looks massive, but flawless execution is key.
Okay, so the key takeaway. Lumentum crushed Q1, driven by data center and network buildouts, huge year-over-year growth in revenue and, crucially, margins. And they're guiding for significant sequential growth in Q2, riding that AI wave hard with their current products.
And the final thought I'd leave you with is this. The CEO specifically said they expect this next quarter's strong growth before OCS and CPO really kick in.
Right.
So if they actually hit that aggressive Q2 guidance, mainly with their current stuff, just imagine how much more transformative this business could become in terms of scale and efficiency when those next-gen technologies enabling the next AI leap hit commercial scale in 2026. It really becomes a question of how fast the market adopts versus the fundamental momentum they already have.
The potential upside is definitely something to think about. A great reason to maybe dig deeper into what co-packaged optics and optical circuit switching really mean for the future. Thanks for joining us on this deep dive.
My pleasure.
We'll catch you next time.